Hello and welcome to another edition of AFR's Market Pulse. Today is August 2nd. It's Friday. It's a little late in the day and we've seen a significant move. Originators are staring at a bunch of green on their screen, and we're going to go into what happened today in the BLS jobs report, why things are moving, and take a look at some charts. We're looking at the 10-year here, and this is just a 5-day chart. You can see the drastic move that we've seen. We had some momentum in a shift. Things were moving downward anyway. We saw, I think we started around 418 or so at the beginning of the week, moved down. We broke through 410, and then we even broke through 4 yesterday for a little bit of time in anticipation of this BLS jobs report. And then it came out at a 114 versus 175 forecasted, some downward revisions, and the traders had at it. And yes, like the great Rodden Burgundy had said, well, that escalated quickly, and it did. We saw this 10-year drop off a cliff to 379, bounced back up a little bit, and has trended down for the rest of the day, which is a good sign for mortgage rates. Now, mortgages are underperforming. They are underperforming. We're staring at the 10-year now around 380, 381, and mortgages are not quite up to speed with the size of the move on the 10-year and 7-year treasuries, but we're going to keep an eye on that. There's been a shift. Just in a few days. We had our market pulse on Tuesday, and we kind of talked over the CME FedWatch tool and the kind of projection of rate cuts. And we're going to get into that chart here and just look at the difference a few days makes. Just on Tuesday, there was an 87.7% chance that the Fed was going to cut a quarter. And now you've seen the kind of the column shift. On September 18th, there's an almost 80% chance they're going to cut 50 basis points is what the market is saying right now. So we're paying attention to this. I'm not in the 50 basis point camp just yet. There's a lot of data points to come out, CPI, a couple of CPI reports, and another employment report. So there's more data coming. We'll see what happens. But we know when there's a shift or a velocity of a move like this, when rates start to get better, what happens? It's usually this, we call it the old pipeline shuffle. And I just wanted to show a demonstration that when you take a loan and you move it from one lender to the next, what happens? And you wonder why wouldn't a lender just give me a lower interest rate so the loan can stay there? We want to kind of go in the economics here. When rates do get better and you have a chance to shift a loan or move a loan somewhere else or keep a loan with a lender, this is the reason why it's not so easy just to get a better interest rate for your borrower. Let's just say you locked a loan on 715 for 500,000. And all you capital markets guys, don't come at me here. I understand that we don't do it at a loan level. We do it on a pipeline basis. But I wanted to show this so you can see the actual, economics of a per loan basis, so we can understand what happens with a hedge here. But let's just say you take a lockout for 500,000 at 675, and the lender was making 100 basis points of premium or margin, we'll say. At that time, you take out a hedge for that same amount. It's going to be pull through weighted, but let's just say for this, it's for that amount, 500,000. We take that out, and that would be flat. So now the total margin for that loan would be $5,000. Well, it's 8.2. Things have moved and gotten much better, and we're staring at a $500,000 loan at 675 now pays 2%, 102, and there's 10,000 of premium. Well, we've taken out a hedge, so the other side of that, the inverse side of that, is now down 5,000 based on the market move. So we're seeing that we owe 5,000 for our hedge, and the margin is still of what we've tried to capture, which is that 5,000. Lenders don't make more money on a lock that becomes higher in value. There's a hedge that they have to pay for. So what happens if you take the loan and go elsewhere where, well, you had that loan, there's 5,000 of intended margin, and the loan cancels? Well, the hedge doesn't cancel. The move has already happened. That lender still owes that $5,000 for that particular hedge. Now, start doing the multiplication of this, of hundreds of millions of dollars in a pipeline or $1 billion in the pipeline, and what those numbers look like. So let's use taking a loan elsewhere as a last resort. We're going to give you a couple tips for originators to talk through it with the lock desk, your account executives, to find a way to keep the loan at the lender that it's at now. The reason is, if it goes elsewhere, there's going to be these larger losses, and then your future pricing is going to be affected based on the moves that happen today. So if you have to, do your best to try and renegotiate and look at their renegotiation policies, try and keep the loan and get your borrower the best interest rate possible, especially if they're shopping, because of all of the media that's going to be talking about interest rates coming down. And if not, if you have to move it because you're risking losing that particular loan, then you have to move it. Inform your lock desk. Inform the lock desk that you are moving the loan, or that you're canceling the loan, I should say, and that's not moving forward. So that way, the lock desk and the secondary teams can take the hedges off those loans. Because if you kept the loan there and it looks like, especially if it's later stages, if it's after approval and the loan is there and it's locked, that hedge is going to stay on. And if rates continue to improve, there's going to be more losses that are going to be incurred on that particular loan. So it's best to be open and transparent and let them know that the loan is leaving, and cancel that loan as soon as you know it's going to be canceled. You don't have to give them the reason why, but at least send the note in and cancel that lock. So that way those capital markets team can remove the hedge from that loan or from the overall pipeline and not incur any more losses should rates continue to get better. So that's a little bit of advice that we have going into the weekend. We hope you have a great weekend of originations, finding some refinances out there with this significant move, and expect to see, if rates stay where they're at, the 10-year stays where it is at right now, we should see some of these MBS pricing get even better comparatively, because we have underperformed today. So thank you for watching the Market Pulse. Looking forward to talking to you guys next week.